Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone. Welcome back to the Millionaire Next Door podcast. We're in 2024, so Happy New Year to everyone. We had a little break in the action, but we've got a lot of exciting episodes. We just crossed 19,000 views, I'm told. So that's pretty cool. A lot of people are listening, getting a lot of value. Let us know what you think. Today, I've got a guest on the podcast who's joined us. He's a fellow professional. His name is David Marra of Markin Asset Management. They do portfolio management. I thought we'd have an interactive dialogue, hear a little bit about David's processes, what they're doing, what they're emphasizing, and wanted to share that with you. So welcome, David. Thanks for being on the podcast.
Hey, Robert, I'm delighted to be here with you today.
Yeah, great. Why don't you just launch right in and tell us a little bit about yourself, your firm, whatever you'd like us to know, and we'll get into the discussion.
Yeah, sure. So I guess I'll start with my professional background. So I graduated grad school with a degree in finance from the University of Chicago back in the mid-90s. And then a few years out of Chicago, I founded a technology company, an internet search engine company. And for those of your listeners who might remember those days, it was the wild west of search engines. And maybe we're on the verge of the wild west of search engines once again, it seems.
Yeah.
But this was before Google kind of gobbled everybody else up. And that was the first time for me to really get involved with technology, building technology. And it was a transformative experience for me. We had about 75 people building technology at that company. And it really introduced me to the transformative power of compute, of data, of algorithms. And after that venture, I got thinking about how could I bring together my background in finance and investment management with more data, more algorithms, deeper analysis vis-a-vis compute. And in 2010, I founded a quantitative investment research firm using machine learning and other algorithms and other just, quantitative statistical methods. And we started building investment strategies for institutions at that firm. And after a few years of doing that, and we built up this great platform, this compute platform, this data platform, we said, we're adding a lot of value here on the investment management side. Maybe we should start managing our own portfolios for clients. And so in 3 years ago, coming up on 3 years in a month or so, my partner, Matt Kinzer, and I founded Markin Asset Management as a way not just bring research to institutions, but as a way to bring investment strategies to other advisors and their clients.
Yeah, well, that's great. So interesting. You mentioned the early days that we have Earthlink right up. If you remember Earthlink, so they're right in our neighbor. And I still see people, with at Earthlink. I'm like, man, these folks are loyal. They've been there, and that's so. I don't know where they went to, but yeah, keep going. Talk a little bit about your process, what you're doing. We went over a little bit. You talked about capital preservation. That's obviously near and dear to everyone. I come across it. I've been doing this 26 years now with, third and fourth generation clients. So I understand this well, but talk about your approach and how you're integrating that or keep going. Just tell us a little bit more about what you're doing and how maybe you're differentiating yourself.
Yeah, sure, Robert. Capital preservation is important to a lot of people. And so I'll just take a second to explain it. This is good to to kind of review for your listeners, capital preservation is important. And, we can go back to, as an illustration of that, we can go back to just the year before last, right? Markets, equities were not doing well, and bonds were not doing well. And we had a year when the 60-40 portfolio, which most, casual observers think of as a very safe portfolio, down about 20% at its worst point, and ended the year down around 17%, 17 and a half, depending on how you define 60-40. And when markets go down, when people lose that much of their wealth, they often get scared, and it changes their behavior. And one of my lecturers at Chicago was Richard Thaler, won a Nobel Prize for behavioral finance a number of years ago, and he's looked extensively at this. But when the last thing you want to do is to get out of what you're invested in right when it's at its nadir, right? Mm-hmm. You don't want to sell low and then buy high. That's not a way to compound wealth, nor is a way to have a retirement. But that's what happens when portfolios go down a lot. People's behavior and fear kicks in that maybe this could get worse for me, and I don't want to lose more than 20% of my net worth that I've saved my whole life for. So capital preservation is an important activity that we as asset managers do to try to prevent that from happening, so that people don't make bad decisions about their portfolio and don't engage in those natural human biases that kick in, like fear, when things are down a lot. So capital preservation is about, in terms of how to do it, is about using a portfolio construction and risk management to try to first position a portfolio so that things in it are not so well correlated with each other. So it's not going to be down so much. So bonds and equities, are not going to be, but you're in a year when it's down a lot, and your correlations, both, your bond and your equity, are entirely correlated like it was 2 years ago. They're going down together. How do you prevent that from happening? Portfolio construction is the first step, but the second step is risk management. Risk management is a process of constantly looking at the risk exposures that your portfolio is taking, and risk exposures of things that are not in your portfolio, and constantly evaluating that and asking the question, is there something else that will still give me the return over the long term that I'm expecting, but give me less risk? And risk management constantly evaluates what's in your portfolio, what's outside of your portfolio, to try to then constantly update the portfolio so that you can avoid those large drawdowns consistently. And that's, you asked what differentiates us. One of the things that has historically differentiated us as a firm is deep quantitative analysis into the risk exposures that we are and aren't taking, and then combining that with portfolio construction to update portfolios so that we're not in the bad risks at the worst time, and thereby helping investors to avoid those large losses and therefore have a much better income profile as a result of that.
Right. Yeah, no, I completely understand. That's very part and parcel. And we work really intimately with folks. So and to be on the front lines when you get these calls, these concerns, these worries, these fears, a lot of it's about pre-education and expectations and seeing who's suited for it. Over time, you may learn when you go through these, some people aren't as well suited. And so you need to make adjustments just because they're not set up for that environment for their own protection. Or we do get a lot of folks that call, we have a perfectly laid out plan, but they need some funds for one reason or another. Happens practically every day, all week. So we move on with it, and we have a very structured process about how we do that at the time, systematically. But when you're taking those distributions, there's a thing called sequence of return that I'm sure you're very familiar with. Right now the markets are up, so we're letting folks know, if you do, give us advance notice. And I literally mentioned that a few weeks ago on a podcast, and I had some clients say, "Hey, I heard that on the podcast. So I wanted to give you some advance notice. We're thinking about buying a new car, which is not cheap these days, about 6 to 9 months out. So I said, that's great to know. Maybe we can plan around that. But yeah, keep going on your process, whatever thoughts you'd like to share with us. And we'll go from there.
I think as you're alluding to, Robert, the benefit of capital preservation or minimizing exposure to large losses is that you end up with more income in retirement. And this is something in the industry we refer to something like Monte Carlo simulation to generate these numbers. But for the person listening, what that is a simulation technique, a sampling technique, which allows us to build confidence intervals, right? Because different from compounding wealth, which is typically the pre-retirement activity, right? You're saving and hopefully you're getting a good, healthy return on those savings every year. That's compounding wealth. It's a very different mathematics of investment management for income in retirement. And the reason why is as follows. Confidence intervals, the percentage of likelihood that you can take out a certain amount every month of your wealth becomes very, very important in retirement. And confidence intervals are not important in pre-retirement. We just need to compound wealth at a higher rate relative to the risk preference of the person who's investing, to stay within the risk preference, get a high return for that risk. In retirement, income is about certainty, right? And pension funds know a lot about this. High net worth individuals who run family offices know a lot about this. And we know a lot about this, you and I, Robert, dealing with those parties as well and individuals, which is, retirement is an activity where every month we're going to write a check to ourselves, a draw. And we not only need to be able to write every check, we need to be able to write every check with a high degree of certainty. And typically an advisor, like yourself, Robert, you'll use a confidence of like with 90% confidence in your planning software, or with 85% confidence. Most of the advisors I use one of the two. And what that means is with 90% confidence, that means for 9 years out of 10, I can write my usual check to myself. There still might be 1 year out of 10 that I'm not going to be able to write the usual check out of myself. But I would like to invest in something that 90% of the time I can write that check consistently to myself through a 30, 35-year retirement. That's what retirement is about. And in order to do so, in order to deliver on that value proposition as an investment manager like myself, you absolutely have to control the losses you have. And that's why going back to the year before last, when your portfolio is down 20%, you rightly cannot write the usual draw to yourself, because in doing so, if you do that, you're likely to impinge your future income. So the most important thing that I can deliver to somebody in retirement is to avoid that large drawdown altogether. And that's what all of our technology and quantitative systems and all of that is about, is trying to produce that outcome for investors.
Yeah, that's fair. And then obviously 2022 was a really unusual year. Those losses, the big losses in the bond market and the stock market, and the fact that everything was correlated. And when you're down 20%, presumably you have to be up 40% roughly mathematically to be back to even. So we put a huge emphasis on that too. Having said that, though, I mean, we've gone through those periods. They're rare. We've seen them. We prepare people to let them know sometimes they do come along. If and when, say, the Federal Reserve is going to raise rates 11 or 12 times in a very short period of time to combat rampant inflation, by printing massive money after the COVID shutdown, that, and then COVID, that just changed. There was just nothing like it historically. So sometimes we can simulate these things, but sometimes we've lived through these periods. I was doing this in, the great financial crisis, right? Or 1998. So we've seen this. And then we do have folks too that still do need to take that distribution, right? Maybe they're taking RMDs, or this is their income. So we have to ride through that and know how to deal with it. It does come up, but it's a really guided thing. And those can be scary, but we call ourselves the noise canceling headphones. It's not that we ignore everything, but we try and give people perspective. And it's not uncommon for clients to see things down in the face of fear and say, hey, maybe we should be getting our, buying ready to go, for people who can do that, have the dry powder. So there's a lot of nuances. It's just guidance through these things. It is really interesting to see how people handle it. Institutions and whatnot, they're sophisticated. They have people who understand these cycles. Sometimes when it's your own portfolio, it's really alarming. So, folks who've been doing this 20, 25 years, they're used to seeing this. They understand this. They remember that. Folks who are somewhat newer, it can be a little shocking. So just sharing some common thoughts, but really we're right on the front lines. You probably see it yourself, and you try and walk people through a very systematic process. And that's what we do. And we're focused. We don't really like to see things down much at all too, because we're fee-based financial advisors here but at any rate, we've seen most of the cycles. We'd never seen a COVID because that was a one-off with respect to shutting the economy, right? That was you look back across the economists, they just can't give you any comparison to what that was like. But okay, I'll let it go back to you. You go along and tell us a little bit more what's your process and what you're thinking, and we'll keep going here.
Well, just on COVID, you're absolutely right. We have to go back to, I think, 1917, 1918, something like that for the last pandemic.
Right.
Yeah.
Yeah.
And so there's just not many pandemic data points in the historical.
There was a Spanish flu, or there was a horrible that it wasn't even the fault of. I heard it was something else they got labeled with it, but yeah, it's kind of hard to compare.
That's right. I was referring to the Spanish flu, right?
Yeah.
But you're absolutely right, Robert. I mean, there's not much data for pandemics, but I will say that crashes are common. Economists estimate that in any 10-year period, there's a 33% chance that you will have a 2007 global financial crisis type of crash. So every 10 years. If you think of that, every 10 years, there's a 30% chance of that. In a 30-year retirement, you're almost guaranteed one. Right. And that's why, essentially going back to what we were talking about, that's why capital preservation becomes so important, and avoiding the drawdown altogether, not being down. It's one thing, as you talk about, Robert, and it's totally true, to educate clients that, yeah, these things do happen now and then. And, if you hold on long enough, if you can, you're likely to come through it just fine. It's very hard to do in the moment. So that's why I say, me as an asset manager, what I can do for clients is avoid it. And that's what we helped, clients do last year, was to avoid a lot of that drawdown just to begin with. And that begin playing through the mathematics of income. That means having that degree of certainty. Allows people to take out more income per year. You actually can generate more income from a fixed amount of assets if you can avoid those large drawdowns.
Oh, 100%. Yeah. And it's really nice. It's satisfying to see them generate that income and, and the independence that provides for them to live their lifestyles. At the same token, though, we're always on the lookout for these big events, right, that you talk about once every 10 years. I mean, I think me and my team, we're pretty concerned about the very large accumulation of, debt, of borrowing, of printing of money, of giant inflation, it's getting, we're going to be okay for a while, but it's starting to matter. So that's a thing we're looking at closely and trying to keep cautious. We don't want to miss out on growth or income opportunities, but we always have to be watching that, that capital preservation piece. And oddly enough, in my experience, I don't know about yours, but these things that are these giant events you're always worried about something. It's usually something else that sort of, blows up or goes wrong that may, there is something, but a lot of times it's really difficult to to see with perfect clarity. So all these predictions about the future, I don't know. I'm not a huge fan of. That's why what you mentioned, the AI, the algorithms, the statistics, watching buy and sell, supply and demand. The market's an awfully good predictor of the future. It's pretty darn smart, So those are just some observations. Yeah.
Markets are very efficient, and prices. I mean, I certainly believe it. I think there's a lot of evidence for that. Prices pretty much reflect all of the information that we have available, or most of the information that we have available at any point in time. And like you said, it's hard to get ahead of the market. But that's where, just coming back to risk management is not really about looking far ahead, because as you point out, we cannot make big predictions about what the S&P is going to do in a particular year, or what bond returns are going to do in a particular year. That stuff is very difficult. What risk management about is looking in real time at what the current situation is, and then figuring out, okay, what do I need to get out of my portfolio, and what I need to get into my portfolio to minimize or to manage the risk exposures. I think something that a lot of individual investors have an impression of, maybe, that what fund managers do is kind of akin to stock picking, right? They're trying to pick the winners, so to speak. And that's not really how we look at it. And I think, dealing with a lot of institutions over the years, that's not how most institutions look at it. There's always an element to you want to pick the winners versus the losers. That goes without saying. But the image of that, as fund managers, we sit around picking winners and shorting losers, is really not it. What
Right.
we really do, and again, this is what our firm is about, but I generalize it more, is that it's about examining your risk exposures, right? Return is a function of the risks you choose to take and the risks you choose not to take. And the key to risk management is to figure out which risks you want to be exposed to at a certain point in time, because that's consistent with your investment mandate, those outcomes we're looking for: compounding wealth, providing income. And also then looking at what risk exposures we don't want to take. So as an example, if I look at late last year, we have, for example, we maintain models for all our different asset classes. We have a huge bond model that consumes lots of data and is updated every day, and gives us a position across durations about what we think the attractiveness is and the risks are of each of the different durations, from 1 year all the way up to 30 year. And, the bond model was telling us in late last year that the bond market was a little bit out of whack with the fundamentals, that bonds rates, so interest rates, in other words, were too high relative to the declining growth rate fundamentals we were seeing. So that told us to get more into long duration bonds in the fourth quarter of last year. In other words, that was a risk exposure that we wanted to take, right? Because we saw that the fundamentals suggested that rates were going to come down, and indeed, they did come down over that quarter, and I mean, that proved, very, very fortuitous for our investors. But it's about constantly looking at what the opportunity set that is out there in different things, different pockets of equity, different pockets of bond, also in different strategies at our firm. We do shorting in our hedge fund. And then, we invest in commodities in some of our strategies. So we're looking across these asset classes and constantly evaluating what's safe to get into, and what's going to deliver that expected return. That's kind of the process, Robert.
Right. I understand. Yeah. And the process is so important. And, we're looking at the fundamental factors. We have looked at a lot of momentum or relative strength. I've explained in a relatively simple way to clients, where they really get, one is about the valuation. The other is also about the timing, and maybe marrying those two up, sort of like playing the piano with both hands. And you talk about us picking winners, or, we do see what does really well, and we can see sometimes what might be the losers and trying to avoid those. So there can be a pretty big nuanced differentiation over time if you're just constantly running it through the process. And I never seek to be amazed how, when I look across all these portfolios, it could be one or two things that you see the Apple in people's accounts, or Nvidia, or just what they put in and what it's worth. And you could have a bunch of sort of midland performers, but there could be one or two just drivers of, massive outperformance. And you don't need that many of those. And it's mind blowing. But hey, before as we start to kind of wrap up, because there's a lot of process going on, I want to get your take. I know you spent a lot of space sort of in artificial intelligence, algorithms. That's a huge topic du jour because it feels like we're at a really interesting point in history. It's been around for a long time, but now it's being used. I'm using it in my process, to a number of ways that I never thought for time savings. I'm looking at data coming off my watch, my ring, for sleep, for all, I'm measuring my HRV like every single day, heart rate, it's amazing. So I'm curious your thoughts. And then, there's a plus side, a minus side, robots are taking over the world. I was reading where they had an art competition, a global one, and people submitted all this thing. And I think an AI driven thing won the competition, which is a little freaky to think that something with no emotion or human personality would win an art contest. But that's a long segue. Let me know a bit about your thoughts of where we're going or how you're using it, or just I'll leave it open to your comment on this.
So I think we're going to, as you pointed out, we've been hearing about machine learning and artificial intelligence now for a while. Last year with ChatGPT, generative artificial intelligence came along. I've been involved with it, as I talked previously, in developing these algorithms, coding these. I'm a coder, coding them, and of course, using them. I've also been involved because I was a management consultant for quite a number of years before getting into finance. That, back in my management consulting days, part of what I did was build machine learning and other statistical systems and implement them in companies to help them do all kinds of things more efficiently and more effectively. And I can say from that experience, that was very, very difficult work to do 10 years ago. It was not easy to implement these models in company processes 10 years ago. Companies didn't have the right data sets. They had to build them from scratch, cobble them together from their global operations. Then you had to build models, and the models were very finicky. You had to have armies of data scientists to program them and maintain them. Generative AI is a very, very different technology because of the fundamental models that they build them off of, which has sort of sucked up everything on the internet, and it's sort of sitting there waiting to be tapped. That means that a company can now just add its own data set on top of these fundamental models and what they call foundational models, and really get going very, very quickly. So this technology, in my opinion, is a very, very different wave of AI than we've seen before. And I actually blogged recently on our company website about the implications of generative AI for global growth rates. And looking at what some NBER, National Bureau of Economic Research economists have looked at in terms of what their impact is going to be on global growth rates. I would say, based on what the economists are saying and my own experience now seeing how much easier this generation of AI is to implement in businesses, that we're sitting at a point in time which is probably similar to the kickoff of the Industrial Revolution. So the Industrial Revolution was a period when global growth rates were extraordinarily low prior to it. We get to something like 1847 when they call it the second Industrial Revolution, but economists do, but that's when they date it. And all of a sudden global growth rates take off. It's literally the hockey stick type of image. I think we're at another point where this technology is going to kick global growth rates into much higher gear because it can have such a profound and large impact on productivity and therefore margins and margin expansion and earnings in a very short time with relatively little effort. So I'm I'm very bullish on it as a tool. We're actually offering an investment strategy that allows investors to invest in the next wave of AI beneficiaries. That means companies, not just in tech, but in all sectors, who are going to benefit from using this in their business processes. But more broadly, I think that this is a technology that's here to stay. It's going to have long legs. It's going to move at along Moore's law, which means every 2 years, it's going to double in terms of its capabilities. And I think so I think there's very, very profound, not all positive, because it's going to involve a lot of disruption. Any form of automation involves a lot of disruption to jobs and things of that nature. But so I think it'll have very profound implications from an economic point of view and from an investor point of view. I think, however, as you were pointing out with the example of the computer generating art and then winning a contest, I'm not sure that we really want to go there as a society, right? I think there are profound questions about AI. It's not just a form of automation like a railroad is to get you from point A to point B a lot quicker. It's a form of automation which does a lot of the work that has happened in the human mind to date, and machines have not been able to do it. I think as a society, we need to start to think about that and think about where we want to sort of draw the boundaries about what we want AI to actually do and not do for us, because it could certainly do things for us that maybe we are not going to make us happier and more fulfilled as human beings.
Yeah, I think that is the concern. It's moving so fast, but our ability to process it or understand it, there's things that are amazing. I heard something from a really credible podcast. I forget where it was, but the human brain, or one of them, is like processing speed is maybe 10 to the 16th of something, but the AI is at 10 to the 14th, but it's moving so fast, it's going to overtake that. When you hear all kinds of crazy things, like even versus physicians, they say their bedside manner of some of this AI is actually better. So some of the, it's just, I think you're right. How we're going to handle it concerns a lot of folks. I do know, I just came from a conference. They were showing corporate profits. I mean, they are at record highs and they just keep growing. So there are enormous efficiencies. I'm positive on it, but I don't fully understand it and the speed with which it's moving. You might be moving faster than the Moore's law, right? Possibly. But it's Moore's. Yeah. At any rate, it's a really interesting period of history. So, maybe we'll start to kind of land the plane on the discussion for today, given the timing. But any other really big points, salient points, anything you'd like to close or leave us with, or thoughts? I really appreciate you coming on. So, please share anything else you'd like to share with us.
No, Robert, I think we covered an incredible amount of ground in a short period of time. So I don't think, if you have something else, I'm happy to answer it.
No, nothing much. I mean, I do love that. Maybe I'll have you back on. We could talk some more about AI and where that's going, because I think it is. I loved your analogy or comparison to the Industrial Revolution, or when things take off or hit a tipping point. It feels like we're there. We don't know how to understand it, but it's a little scary too, what it means. And then the link to your happiness or fulfillment, that those could be very disconnected. So we're trying to utilize all those factors. But I really appreciate you coming on. It's been terrific meeting you. We can put some links in the show notes. If there's anything you'd like us to include, let us know. And really appreciate it. And have a great day, and Happy New Year to everyone. We'll probably release this in, sometime around February of 2024. We're recording it mid to late January. But I appreciate it, David. Thank you so much.
Thank you so much for having me on. It was a pleasure.
Yep. My pleasure. Yep. Have a great day, everyone. Thanks.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors.
Signature Estate and Investment Advisors, LLC, SEIA, is an SEC-registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities, Inc., member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.